All right, welcome to Chapter 9. Um, this is reporting and analyzing long-lived assets. So we're actually on the bottom part of the balance sheet for the assets, property, plant, and equipment, and intangible assets. So the first thing you're going to be learning real quickly is exactly how do the numbers get calculated on the balance sheet. So when you see there's an account land and a number $12,000, how exactly do they come up with that particular number? So the first thing we're going to do is actually going to explain that, and you can do a little bit of calculation. The second thing we're going to introduce you to is all those depreciation methods. There are a few, but of course, overwhelmingly, one of these depreciation methods is followed by most companies. So we're going to focus on that. Real brief explanation as to what happens when a company gets rid of property, plant, and equipment. They sell an old truck, or they sell off a machine, or they trade it in for a newer one. How do they account for those in the record? Then we're going to be looking at some introductions of intangible assets. Those are very important to know today. And it's really sort of an introduction to what each of them is about. And the last thing we're going to be doing is a little bit of financial analysis on those assets at the very, very end. A couple of very simple things that we look at. Okay, so first things first, the first objective, why is this accounts receivable? Everyone just see that? Oh, look at that. They made a mistake on the slide. Ha! Isn't that weird? Explain how companies recognize accounts receivable when they go into plant assets. Wow, that's so weird. So anyway, this is not about accounts receivable. This is just an error in the slide. Someone got lazy down at Wiley and never changed the title of the slide. Ooh, wait till I hear about that. Anyway, plant assets, how we recognize plant assets are really the thing. So this is property, plant, and equipment. This is how we've been learning them. Sometimes it's known as plant and equipment, or back in my generation, we learned those as fixed assets. But they're all the same. They have a physical substance to them. So like, you can touch the land, you can touch the building, you can touch machinery, you can touch a car or truck. So that's the physical substance. They are used in the operation of the business. So they're not for sale to customers. They are used for business. You walk into a pizza parlor and the pizza comes out of the oven. You don't say, hey, I don't want to just buy the pizza. I want to buy the oven. The oven's not for sale. The oven is used in the operation of the business. So they're not intended for sale to customers. And they are expected to be used by the company for a number of years. Thus, they are long-term assets, right? Over 1 year. So how long do they use trucks? How long do they use those pizza ovens? How long are buildings used for? They all have a useful life. And you're going to be learning a little bit about that as well. Some companies have a ton of property, plant, and equipment. Wendy's owns all their buildings. They have, of course, refrigeration systems and all the system that they use for cooking, whether it's a fryer or stoves and things like this. The machines that make the Frosties. I'm kind of thinking I need one. Lots of things, plus the counter space, the tables and chairs, the building itself. Believe it or not, they own the parking lot, they own the drive-through equipment, they own all that stuff. That's all property, plant, equipment for them. And so they obviously have a lot. Obviously, airlines have a lot of fixed assets because those are the planes. No plane, no airline. They have lots of that type of equipment. But as you keep going down, other companies may not necessarily need a lot of property, plant, equipment to function, as you see. What you actually see on the balance sheet is the historical cost of the asset. So we go ahead and we buy a truck, for a delivery truck for a company. Well, what we really need to do is figure out exactly how much that truck cost us. And it's more than just the purchase price, as you'll see in a moment. Anything we need to get it ready to run in the business is basically going to be the cost of that truck. And that is basically what you're going to see on the balance sheet for the value that, the beginning value of that asset. Okay. So again, the cost is the idea that how do we make it ready to use? So buying a truck in and of itself isn't enough. It's not ready to use. You might need to add special shelving on that truck if you're going to be delivering things. That shelving allows that truck to be ready to use. You might also need to paint it and put your logo on it because all your delivery vehicles is painted certain colors and have your logo on it, and then it's ready to use. And so whatever the company feels as though whatever makes it ready for use, all of that amount of money they spend is the cost of the asset. Okay. We're going to distinguish between a revenue and capital expenditure in just a moment. This is a couple of slides down. So what is the cost? Well, the cost is, of course, measured by the cash that's paid, right? But it's a little bit more than that because what we really have to look at is an issue of fair value, okay? And so this is especially noted internationally. What we look at in terms of fair value is on our balance sheets is looking at, are we overstating the real value of the asset or are we not? This is sort of has to be balanced with the historical cost principle that we look at. So let's take a look at our property, plant, and equipment accounts. The first account that's always listed on property, plant, and equipment is land. Okay. Land is a very specific PPE account. And the costs to buy the land is more than the cash price. Because land is real property, you have closing costs, which means that you have to have it transferred legally into your name from the previous owner's name. And so that's going to be a title fee, and you're going to need attorneys to make sure that legally all the processes followed. So you do take property ownership of that asset. Oftentimes when we do buy real property, we usually have either the buyer or the seller or both are represented by a broker. And so there's commissions that have to be paid. And that's actually part of the costs of buying the land. So we include that. And then the land you purchase might have some back taxes. It might have some old stuff on it that needs to be cleared up. There's a number of different things that might happen in order to get the land ready for use. Okay. And so whatever we have to pay to make that happen is also part of the cost of the land. So here's an illustration. A manufacturing company acquires land for $100,000, but the land has an old warehouse on it, right? It's raised, which means it's torn down, it's taken down and cleared away. That actually cost the company $6,000 net, which means that it actually costs $7,500 to take the old warehouse and stuff out. But they found $1,500 worth of assets that they could sell to offset the cost. So $6,000 is the net cost. Of course, they had to pay the attorney's fee and had to pay commission. So how would we recognize the real cost of the land? Well, it's all of these things. Okay, the real cost of the land is the actual price of the land, the cash price of the land, plus the removal of the warehouse, because that you need to remove it to get the land ready for use. Remember, that's the standard, ready for use. You got to pay the attorney and you got to pay the broker. So the actual land account would be debited $115,000 because that is the real cost of purchasing that land, purchasing that asset. Okay. This is another property, plant, and equipment. It's another asset account called land improvements. So anything on the land that's not a building is basically a land improvement. So driveways or a parking lot, any fences, landscaping, sprinklers, lighting, other systems that you have is all part of what we call a land improvements account. Okay, so it's a real asset account. But unlike land, which of course we assume land is good forever. Right? You can use land for anything you want, anytime you want. It's always going to be good. So land actually has an unlimited life. You can't measure the life of land, and so land doesn't depreciate. But that's not true for all the other property, plant, and equipment accounts. Driveways only last so long. Fences only last so long. Okay. So in other words, they have what's called a limited useful life. Okay. And so because they have a limited useful life, at some point in time, you're going to need to repave that driveway or repave that parking lot or replace that fence or et cetera, right? That's basically what we're talking about in terms of a limited useful life. And so basically that's where depreciation comes in. Depreciation says, okay, because I'm going to be using this parking lot for 10 years before I have to have it repaved and repaired, then whatever cost I had to build the parking lot, I'm going to depreciate over that 10-year period of time. Okay. And so it's going to be added to depreciation expense, but the parking lot's also going to have an accumulated depreciation for it because we're going to be slowly expensing it over, say, 10-year period. Okay. So that's how depreciation works, and that's why it applies only to plant assets. Another very popular asset account in property, plant, equipment is buildings. And so for buildings, it's all costs for doing one of two things. You can either purchase an existing building, or you can construct a building because there's nothing there right now. Okay. And so when you purchase an existing building, clearly it's the purchase price of the building. You're also, again, it's real property. There's going to be closing costs involved. So you are the recognized legal owner on the books of the government. So it recognizes you as the owner. So there's going to be attorney fees, title fees, real estate commissions, blah, blah, blah. But the one thing you have to understand is when you buy a building, a used building, you need to make sure that it's up to standard. The local laws require, and state laws require buildings have certain access points for disabled individuals. There's a lot going on in terms of the building. Certain electrical standards, plumbing standards, other types of standards have to ventilation, et cetera. All if it's a restaurant, particularly. So there are all different types of standards that it has to meet before your building can be useful, can be actually used to be whatever it is you bought it. So any remodeling or replacing or repairing costs are actually part of the purchase price of the building on the balance sheet. Okay, because again, the purpose is to get that building ready to use. And if you have to do all of this stuff before you get it ready to use, then that's part of the cost of the building. But what if there's nothing there? Right? You bought a piece of land and you want to construct a building. Well, then all those construction costs, okay, need to be part of the cost. So you're going to need to pay an architectural firm to design the building and get all that stuff. You're going to need to pay for permits to get the building built. You're going to have to make sure, depending on the size or height of the building, that it's solidly, if it's a skyscraper like in New York City, it's going to be embedded into bedrock. So if we do get a little tremor or an earthquake, it doesn't fall down. And so basically there you have a lot of costs that involve excavation costs can be very, even for very small digs. But if you're actually having a skyscraper, you got a huge dig down, like I said, to that bedrock piece. All that's going to cost a ton of money. And then of course you got to then you got to pay to build a building. So again, and that's the contract price. So when you're actually building a building, there's a lot to it. There's a lot of pre-work prior to actually constructing. And we're seeing a lot of that. I was just up in Hyde Park over the weekend taking a walk at the Roosevelt farm. And again, continue to see more and more construction going up Route 9 from, say, Marist College up to where the Stop and Shop is in Hyde Park. Lots of construction going on both sides. And you see that, in the case of the old state hospital, they're raising buildings and flattening out the earth. That's all going to be attributed to the land account for that company. And then, of course, you have a spa, a new hotel spa that's going to be built across on the CIA. And again, they're going through all of this. They had to pay an architect to design it. They have to pay for permits. They're excavating before they actually start construction. All of that's going to be associated with their building account. And of course, equipment. Equipment, you can throw a lot of things into equipment. Or you can break it up. There's machinery, there's vehicles, there's furniture, fixtures, things like this. But anyway, all the costs incurred in buying that equipment is part of the equipment account. And to make sure that equipment is ready for use. And depending on the equipment, not all equipment is ready to use as soon as you break it out of the box. Sometimes you need a special foundation for certain equipment, like HVAC systems might need to have a special cement foundation to be bolted on outside of the building. Guess what? You have to do that in order to use it. So guess what? It's part of the equipment account. It's quite part of the price of purchasing that HVAC system, for example. So again, not just the cash price. Equipment tends to be in that taxable category. So there's sales taxes to pay. It's not like you're buying this from your next door neighbor. You're buying it from companies around the country or around the world. And so there's freight charges. If you're having it shipped, you need to make sure it's insured. So whatever you need to do to get that. And then, of course, any type of assembly, any type of installation, any type of testing. Believe it or not, even if you have to train employees to use it because it's a new machine that hasn't been used before by anybody, all of that is part of the equipment account. Because again, it brings it up to that, is it ready to use for the business? So it's very, very fascinating. So here's an illustration from a company, Leonard. They purchase a delivery truck for $22,000, must be a pretty small truck, for 22 grand. They had to pay sales taxes. They painted it and lettered it into there. There was a motor vehicle license, and they had an auto policy that they paid. So what's the actual cost of the truck? Well, again, the cost of the truck is everything you needed to get the truck ready for use. So you had to pay for the truck. You had to pay for sales tax on that truck. And then, of course, for this business, it was important that that truck be painted and lettered with the owner's name. All of those are actually the cost of the truck. The motor vehicle license, I mean, trucks don't drive themselves. Well, they might soon, clearly, but trucks don't drive themselves. The motor vehicle license is to get the person ready to drive the truck, not the truck ready for use in the business. So the motor vehicle license is actually an expense to the company. And that insurance policy, every time you buy insurance, it's prepaid insurance. Prepaid insurance has its own account. So that's why it's not part of the cost of the truck. But the cash price, the sales tax, and the painting and lettering is required to get that truck ready for use. Again, that's important. So in terms of how it would look in the books, the journal entry on the books for the company, this Leonard company, their equipment account would be debited by $23,820. That's the amount of the truck plus the sales tax plus the lettering. The license would simply be an expense because it's not for the truck, it's for the person who drives the truck. And prepaid insurance is going to get the debit every time you buy insurance, regardless of what you buy it on. Okay, now this is where I'm going to get back to that revenue and capital expenditure piece from the earlier slide. If all these assets are you're gonna use for a long time. When you buy a car, you need to assume that if you want your car to last, say, 6 years, 8 years, 10 years, there's a certain amount of assumptions you need to make. One of those assumptions is you're going to need to do regular maintenance, right? And that's simply because maintenance is required to get the truck or the car to last you 8 years. You need to have regular maintenance. So regular maintenance is actually an expense. Maintenance repairs expense is simply a general expense. And so changing the oil, changing the tires, changing the filters, those, changing the windshield wipers. This is just typical, changing a light bulb. This is just a regular expense. Okay, you need to do that just to make sure your car is going to last the period of time you want it to last. So we actually expense those. But what happens if we actually increase the useful life of a vehicle or any other equipment, for example? Let's say we had a truck and we were thinking the truck's going to last us for 8 years. But 3 years into the truck's use in your business, something went wrong and you had to overhaul the engine, which basically means the truck's got a new engine. And so now that the truck has a new engine, you can actually use it longer than you planned. You were planning on using it 8 years, it's 3 years in, you were planning on using it just for 5 more years. But now you got a new engine in the truck. Guess what? That truck can last another 8 years now. So that is called an addition and improvement. It's an addition and improvement because the useful life to the business of that asset has now expanded beyond the original. Because we had overhauled the engine of that truck now has a longer useful life for us. And so that basically, whatever money we spent will be debited into the equipment account for that truck. It will not be expensed as maintenance and repair. It's actually going to be debited directly to the asset. So that's the difference. This is also called a capital expenditure, whereas an ordinary repair is simply called a revenue expenditure. So that's how it's related earlier to that slide. Okay, but again, if it improves the useful life, means it's going to make it last much longer. You're debiting it direct to the asset. And that's because you can expense that as depreciation over time. Okay. So that's the only tricky part here. You've seen a lot of fraud lately, so we're going to spare you here. I'm not going to go into the idea of a lease here, but just for you to understand that leases are tricky in accounting because you don't technically own the asset because you are renting it. However, you are using it for the long term. I mean, a lot of airlines lease their planes. They don't buy outright. A lot of airlines will lease their planes. So how do they show it on their books? Well, a lease is a rental. So, which comes down to, it's going to be a rent, sort of a rental expense for the airline, right? However, they're using it for 10 years. So in a lease, they actually have to show, it as both an asset and a liability on their books. It doesn't actually have to be in the balance sheet, but it has to be in the notes to financial statements that explain that, look, we have we have $10 billion worth of planes that we're leasing. So yes, we're using them for 10 years. So yes, they are technically assets to us, but we owe all that money on them in rent, et cetera, over the years. So it's actually a liability as well. So again, it's tricky. You don't need to really kind of know that now, but you will need to know that as you move into deeper levels of accounting. So leases sort of are interesting to look into. All right, so now we come to the big part, is those depreciation methods that we talked about. So again, depreciation allows a business to allocate the cost of the asset over its useful life. The purpose is to look at its useful life. How long are we going to be using this asset? And what portion of the value of that asset are we using to generate revenue? So again, it can be expense because it's directly linked to revenue. Without a delivery truck, you're not going to be delivering packages. If UPS is not delivering packages, it's not making any revenue. But because it has the trucks and it makes those deliveries, the truck is related to the revenue of the company. So the truck can be expensed through depreciation. A pizza oven is necessary, like the refrigeration systems in a pizzeria are necessary to keep everything fresh, right? So it can be created into a pizza, which can be cooked and sold to the customer. And so again, all that equipment is directly related to the revenue generation of that business. And thus it can be expensed through depreciation. The building as well. Without the actual building, people can't come in and eat and relax and so forth. Of course, now they're not doing much of that these days without a mask on anyway. But again, it's all part of, is it generating revenue for the company? If it is, it's subject to depreciation, okay, if it's a plant asset. So again, that depreciation only can happen over the useful life of the asset. Only through the useful life. So a delivery truck might only be good for 4 years, 5 years. Pizza oven, refrigeration systems might be 10 to 20 years. Building might be 20, 30, 40 years. So there are ways in which they can calculate this that they have in accounting that you'll learn a little bit about. But basically, the depreciation comes as it relates these assets to generating revenue. Thus, it can be expensed. So this is actually in a cost allocation. It's not technically, a write-off of sorts. It's more of a cost allocation over time. It applies to all the property, plant, and equipment accounts except land, because land has an unlimited useful life. Okay. Land is just a different category of plant asset because land is always useful. The only way that changes is if you're in farming, forestry, or you're in mining and the reason you bought the land because there's gold there or oil in it. Then there's something called depletion that affects those types of assets for those specific companies. But for most companies, they buy land because they want to put a building on it. And, so the land is always going to be useful. They can tear down that building and put up a factory. They can tear down that factory and make it a parking lot. The land is always useful. So the land never depreciates. But everything else has a useful life, in which case it needs to be replaced or repaired or what have you. Okay, so it's depreciable because, as I mentioned, because it contributes to revenue. Right? Like I said, that delivery truck contributes to the revenue for UPS. The pizza oven contributes to revenue generation of a pizza parlor. So those are subject to depreciation. Okay. How it works is it all starts with learning objective 1, where we actually first created and calculated the cost of the asset. Okay. The second step is how long are we going to use it for the business? That's a useful life. And then at the end of that time period, will the asset have any type of value remaining? Okay, at the end of its useful life. Now, it depends on the type of property, plant, equipment. If you have computer equipment, no one's interested in buying a 4-year-old computer. So the salvage value is going to be zero. There's no way it's going to be hard even just to give it away. But, old police cars, old delivery trucks, they still sell them. They're still actually out there. So they will have some type of salvage value at the very end. So the difference between what you paid for it, the cost, and its salvage value when you're done using it, that difference is the only thing you can depreciate. And you depreciate it over its useful life. Okay, so what it's 10 years, 8 years, what have you, that's how long you're depreciating it. There are lots of different depreciation methods, including one that's used for taxation that's not listed here. But as you see, the winner clearly is straight line. Okay, so we're going to be focusing on the straight line method. Although, there's other methods as you see here. Thankfully, they have all conceded to straight line, so there's no, challenge to this poll. So we're going to be focusing on the straight line method just to understand how depreciation works. You're not going to be an expert in it, but it is easy to understand. So here's how, and again, we're just going to focus on straight line here. So here's an example. We have Bill's Pizza. They purchased a small delivery truck on January the 1st, 2017. How small was it? 13,000. You might have need to pull the string on the back of it to get it going. You might need to push it downhill to get it going, but that's a really small truck. That's the cost of it on their books. Okay. They plan to use it for 5 years. When we look at straight line depreciation, we are going to be looking at the number of years. Okay. And after they're done using it, they do expect it to still have a salvage value of 1,000. So what they're going to be doing is they're going to be using up in that 5-year period the difference, which is the $12,000 difference, right? Between how much they paid for it, 13,000, minus how much it will be the salvage value, which is 1,000. The difference is 12,000. That $12,000 is going to be expensed over that 5-year period. And that's basically how straight line works. Okay. There are other methods that I'm not going to get into. The miles is the unit, and declining balance is simply like an accelerated method of depreciation. We're not going to need to know that. Simply straight line. So in this case, straight line method is quite easy. Again, all you can expense over time is what you're going to use of value in that asset. You're using something called the depreciable cost, which is what you paid for it minus its salvage value. Cost minus salvage value, depreciable cost. This is simply going to be divided by the number of years. And that's going to be your annual depreciation expense for this truck. And that's how it works. It's quite simple, nothing to worry about. The interesting thing, of course, your book has this illustration here, which shows how much of the rate it is. But basically speaking, I want you to focus on 2 columns here. Okay. Every year, starting in 2017, all the way down to 2021, every year you're going to be making the exact same journal entry. You're going to debit depreciation expense for $2,400 for this truck, and you're going to credit accumulated depreciation. Okay. But you should know, right, that depreciation expense accounts are part of the closing process at the end of the year. So expense accounts are going to be zeroed out at the end of the year, right, through closing. However, accumulated depreciation is an asset account. It's a contra asset account. It does not close. And so you can see how depreciation accumulates over time. Every year you're going to be expensing $2,400, but as you see, every year accumulated depreciation is going to be $2,400 more, because this is the total of all your expenses over time, the accumulated total. So every year you're going to write this thing off, your cumulative depreciation is going to get larger by $2,400 until it reaches the total depreciable cost that you calculated on this machine, which is $12,000. Of course, the interesting thing about here as well, the third column will show you the actual book value of the asset. Now remember, you paid $13,000 for this truck. Okay, that's the original value of that truck, $13,000. After you expense the first year, you have $2,400 in accumulated depreciation. So 13,000 minus 2,400 gives you that book value of 10,600. Again, it's the cost, 13,000, minus the accumulated depreciation, 2,400 in this case, book value 10. Of course, this cost never changes. You've already figured this out. That is the cost of the equipment. However, look what happens every year in accumulated depreciation. It keeps going up, $2,400 in this case, right? So you're simply subtracting the accumulated depreciation total from the cost to get its book value. Every year, the book value will decrease until it reaches its salvage value. That's the lowest it can go, is that $1,000 salvage value for this particular truck. And so you should know how to read this chart. If you purchased it mid-year, then you can only write off, again, this case, they purchased it on April the 1st instead of January 1st. So it's the same calculation, but the only difference is the first year you can only write off 9 months of the 12-month period for that very, very first year. What happens to the other 3 months of that year? You write it off in the very last, at the very end. You're still writing off 5 full years of depreciation, but you split one of those into 9 months and into 3 months. You're still getting a full 5 years. No change. Cumulative depreciation will wiggle around a little bit differently until it reaches 12 grand, but it will eventually reach 12 grand for this truck. Okay. That's the only difference here. We're not going to do declining balance. It's just an accelerated depreciation model. A unit activity is another method that they use, but they don't use years. Instead, they use units. So miles is a unit for a truck. So every mile that truck drives that year, 12 cents a mile, until you reach a full $12,000 in depreciable cost. That's all. You're still at the total is still going to be the same. It's just that your expenses are going to be different every year with each method. The only benefit to declining balance would be in very, very high tech or industries that use a lot of high technology, because they tend to only use their equipment for a short period of time before they upgrade it to a new piece of equipment. So, for example, hospitals or medical centers that pride themselves on cutting edge technology for, MRI or other types of issues to look deep inside of you, they're probably going to use the state of the art machines. And after a couple of years, they're no longer state of the art, right? There's new machines that come out that look deeper into the body, et cetera. So they probably want to get rid of that machine or replace it. So they probably would use an accelerated method so they can take the cost early. They could reduce that cost early. Everybody else doesn't work that way. So straight line is clearly the winner. Okay, as you saw earlier. Okay. It doesn't affect taxes. Taxes has its own, like I said, the MACRS system is the IRS requirement. And so when they actually go ahead and pay their taxes, their taxes are going to be calculated through this MACRS system for their assets. But what you're seeing on your financial statements is either one of the other methods that we just looked at, straight line being the most popular. And that's pretty much the bottom line there. One thing that you have to, this is an important part too, sometimes the value of the asset will have a permanent decline, and thus the company really has to take the asset either off the books or write the asset down. And again, this, I mean, I can tell you the best example I do have is probably, I think Disney made a movie many years back called Waterworld or something like this. They spent a ton of money on the film, making the film. That's actually the cost of the film. That's actually the value of the film on the books. And of course, it did ridiculously badly. No one wanted to see it. It became basically Water Under the Bridge instead of Water World to Disney. So basically, they knew the value of the asset was wrong. The valuation was not supported in any way, real way. So they basically wrote it down. That was an impairment. So that does happen with certain issues with certain companies. This happened a lot in, you all kind of know a little bit more about the marijuana stuff in terms of medical marijuana. And you probably heard of Aurora Cannabis Company. It's a Canadian cannabis company that sells both medical and recreational weed. They went on a buying spree a few years ago. They bought all types of facilities to expand how much marijuana they could grow. And they spent a ton of money. That value is on their books, is the real cost of those assets. And then, of course, the market just wasn't there. And so all those assets were not fairly valued on their books, and they basically had to write down the assets, which is an impairment. So all that money they spent on indoor farms and that was supposed to grow a ton of weed, just there was no need to have it, and so they had to mark it down. Okay, not necessary to go over too many things here. Learning objective 3 basically looks at what happens when you dispose of an asset. And briefly, all you really need to know is that assets get old and a couple of things happen. They're either sold to another party, they're either scrapped or discarded. We just nicely call it retirement. I don't like that because I'm close to retirement. I don't want to feel like I'm scrapped or discarded. Or they're exchanged for new equipment, right? And you've all heard about this. So basically, there's something that happens here that all you're doing is you're looking at the book value of the asset at that time, and you compare that with how much you sold it for or traded it in for. Okay, you're only looking at those two things. If you sold it for more than the book value, you got to realize a gain. If you sold it for less than the book value, then you mark it down as a loss. These types of gains and losses go on the income statement as other revenues and gains or other expenses and losses. This is where you'll see the sale of plant assets. And again, if I sold you a truck for $10,000 and that was my proceeds, but on my book, the book value of that truck was only $8,000, I made $2,000, I'd have to report it as a gain. And that's basically all you need to know about this section here. Really, there's only like 1 or 2 questions on this. In the case of a retirement, usually there's no cash that's received. So actually, it's basically you take the full amount off the record, and it becomes basically, if there's any book value, remaining book value, it becomes a loss. Okay. Learning objective 4 introduces you to more details about intangible assets. Intangible assets are very important today. A lot of companies are companies that invent things. So they will have patents on inventions, or they've created software or music or something else like an algorithm. So they'll have copyrights on that. Sometimes they actually have things that they can license or sell to others in the form of a franchise. A lot of companies have various trademarks that they own. Some companies want to have a trade name, so instead of blowing your nose with a tissue, you're going to get a Kleenex. The Kleenex is a trade name. So there's things like that, and then I'll explain something called goodwill as an intangible asset as well in this place. It's great. So in many cases, some intangible assets have only a limited life. And if they have a limited life, you can actually, they don't depreciate. Intangible assets do something called amortize. Okay, amortization is something that applies to intangibles, whereas depreciation is specific to property, plant, and equipment. Okay, and so if it has a very limited life, you can actually expense the cost of the intangible asset through amortization. Okay. However, there are some intangible assets that have an indefinite life. And so there's no limit that you can foresee on how this is going to be useful to your company. So there's no amortization. Okay. Patents are very important today. It's an exclusive right to manufacture, sell, and control an invention for a period of 20 years. Now, if you invent something, you apply for a patent, the US Government Patents Office. And what that does is that means it's government recognition of ownership. And once you have rightful ownership of a invention, you can sell it to anybody and make a ton of money. Imagine if you were the person who invented the lightweight plastic bottle with, twist off cap. There's something as simple as that. And you got a patent on that. Then you can go ahead and sell it to any company that bottles anything with your twist off method. And you're going to get a royalty for that invention. Every time they make a bottle with a twist off cap, you might be getting, a penny per bottle and whatnot. Of course, if you sell it to Coke or Pepsi, where they make, millions and millions and millions of bottles, you can understand how that just adds up for you. But it can be any type of invention that gives you a right to patent it. And that's, if you ever watch Shark Tank, that's one of the things that they'll ask some of these people that are inventors is, do you have a patent on it? Because they want to know who owns it. Because that's the whole ballgame. That's the whole ballgame. Owning it is very, very important. So it costs money to apply for a patent. And so that actually becomes the value of the patent. Patents are usually good for 20 years, although they can be, some of them can be extended, some of them can't. Which one can't be extended is medicine. So all these things that we're in a period of time where there's a lot of companies that have these vaccines that they're producing, right? But any medicine that's produced becomes patented, which means that that particular company is the owner of that, no one else. And then again, exclusive right to manufacture and sell it and control it. And that's why in the United States, particularly, we pay the highest prices for medicine, particularly new medicine, because the patent allows the manufacturer of a drug to have a monopoly in the drug for 20 years. Okay. Now, it's not that it might not be that dire, because other companies are also working on drugs for, like you see, there's 6 different companies working on a vaccine. And the third company just announced a vaccine trial today that was successful. So it's not like, it doesn't necessarily stifle competition on a broad level, but it does allow companies who have a unique drug, in this case, to charge anything they want for the drug. And they do. And they do. And so, again, there's lots of medicines for whether it's diabetes or, cancer or HIV or other types of things that are out there, Um, but each of those companies have that patent for 20 years. The patent expires, and that's what a generic drug is. So a generic drug is anybody. That exclusive right goes away. And so anybody can manufacture and sell a generic drug because the patent no longer applies. So, aspirin, that patent's expired a long time ago. Tylenol, that's expired a long time ago. Advil, Motrin, all these things have expired a long, long time ago, which means anybody can sell it, which is why we pay virtually nothing for like a bottle of aspirin today, at a Walmart or your generic, because the patents is gone. They're expired. The reason they also do charge, once that patent gets approved, part of the cost of the patent is the research and development and legal fees. And that really increases the costs a lot. And they want to get all that money back promptly. Okay. So again, patents go through a period of amortization if they have a notable life. And there's an example there. You're not going to need to do it, but it just shows you there. Research and development, R&D, is a very, very important part of all of this stuff, but these are expensed when they happen. R&D happens for inventions, whether it's a drug or a new method of calculating a credit score or any new process or a particular product. All those are R&D related types of stuff, and there's expensed. Copyrights are very important because they give that owner the exclusive right to produce or reproduce rather and sell an artistic work. So for musicians, this is exceptionally important. Okay, you want to make sure, and I've done this with my oldest son is actually quite adept at writing lyrics. He can't really sing all that well at this point, but he does have very good writing abilities for lyrics. And every time he says, "Oh, I'm going to give this to my producer," I'm like, "Whoa, whoa, whoa! Who owns it? Who owns it? Who owns those lyrics? Who owns that song?" Because that is super important to understand, because whoever owns it is going to be able to control it and make money from that. And so that's something that is very, very important for everyone to sort of understand. It gives the owner that copyright for life, plus 70 years after their death. So yes, Michael Jackson is still making a lot of money, even though he's been dead for a while. So is Prince, for that matter. Because every time their songs are used on the radio or on television commercials or whatnot, they have to pay a fee to get that done. Okay. You can amortize it over its useful life because not every song is going to last forever. Not every piece of artwork is going to last forever. Not every book is going to last forever. And so it might have a useful shelf life, and then at the time after that, it's going to lose its value. So if that's what you came up with. How important is it? I want you to remember this song. I don't know if you've heard it before. I'm pretty sure you have. Hey, hey, hey. So, that hey, 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 and woo in the background there, that was actually copyrighted by a group back in the 1970s, early 70s. And so when Robin Thicke and company decided to use it, they never asked permission to use it or pay for the copyright. They were sued because this particular song, Blurred Lines, was a moneymaker. And that lawsuit was won by the group back in the 70s because they were able to prove through their copyright that they actually owned that beat. Hey, hey, hey. Woo! And the court agreed. That's how important copyrights are. That's how important copyrights are. All right, so a trademark or a trade name, it could be a word, phrase, jingle, symbol, what have you. Basically, it's legal protection of exclusive use of that trademark or trade name. These are 20-year renewable periods. So there's no foreseeable end in sight, so there's no amortization. Okay. And this is true, Coke is pulled off a few of these types of things before. I don't know if you know a company called Polar Beverages, but they also sell mostly a lot of tonics and stuff like that in the stores. But Polar Beverages has a polar bear as its trademark. Coca-Cola uses polar bears in the wintertime, right around Christmas time, to sell its Coke. They had a big lawsuit about this. And Coca-Cola ended up winning in that lawsuit because they were able to prove in court that their bear, their polar bear, was significantly different than the polar bear. That's happened before. That's happened before in many cases. Microsoft was sued by Apple because Apple was the company that really kind of introduced the point and click system, where you use a mouse to point, click, bring a menu down, etc. That was originally developed by Bill Gates for Apple. Apple never copyright wrote that. Microsoft improved on that for Windows. Apple sued. Apple lost because Microsoft was able to prove that their Windows codes were significantly different than the codes that they helped Apple develop several years earlier. This is big. I mean, it might sound crazy, but it's big. It's big money. It's really, really big money. It's super important. So a franchise, again, it's a contractual agreement. And a lot of companies are franchises, okay? This license is usually for a limited period of time. The contract usually expires, I think, for like McDonald's, I think after 20 years. But in the meantime, what you have done is you've entered into a contract to with the right to use the names, the advertising, the brands, and run it as a business, but it's not your own business. It's a business that's already been created and sold to you to run as a franchise. That contract binds you to do things certain ways. What happens if you don't do things certain ways? Well, we live in the Poughkeepsie area, so you might know the buffet. What is it called again? Buff Corral, Golden Corral buffet, right? So the Golden Corral buffet has this storied problem because that is a franchise. And the original owner who had the original contract put up the building, all this other stuff, but did not follow various things that were part of the contract. And so the franchisor who owns it pulled out of the contract. And it promptly closed. As soon as it opened, it closed. And then they resold that franchise to another party, and it opened again. And of course, COVID hit. COVID and buffets just don't go together. Lastly, the issue of goodwill. This is a very interesting intangible asset because it really sort of accounts for anything that you really cannot verify in other types of ways, such as when you purchase another building, let's put it this way. I have I've had a barber shop in Poughkeepsie for many, many years. And Brandon wants to purchase my barbershop. Now, usually when you go ahead and you buy another company, you're looking at the balance sheet, say, okay, I'm buying the building, I'm buying this equipment and so forth and so on. It has this type of a value. The company's profitable, I'm buying the earnings, blah, blah, blah. So we tend to look at the financial statements to figure out what the real value of the company is. But that doesn't take into consideration its reputation, its customer base, the way it's managed, how it's viewed. You're also buying, in many cases, when you're exchange of business, sometimes the employees are not leaving and they're exceptional. So you can't possibly put that anywhere other than this category that we call goodwill. Okay. And so when you pay well above the fair market value of the company's assets, the difference is looked upon as goodwill. So I was selling my business for $100,000, and Brandon offered me $120,000. How does he account for the difference outside of all the assets he did buy? Goodwill. This happened with Disney all the time. Disney is one of those companies that likes to buy things at very high prices. So several years back, Disney was having major issues with attracting preteens and teenagers because they didn't have any really desirable characters for them. So they went ahead and they bought Marvel. They bought Marvel for a lot of money, a lot more than what, Iron Man is really worth. The difference they chalked up as goodwill. A couple of years after that, they bought Star Wars. They bought Lucasfilms and all the Star Wars characters, and they paid a ridiculously high price for that as well, much more than the book value, fair market value of the assets. So the rest was goodwill, and that's how they accounted for it on their books. Okay, that's just a little intro to that. The very last piece here, really quickly, is we're going to be looking at a few two ways that they analyze assets. First, your book shows you how they are listed. The most important thing is that property, plant, and equipment does have an order. The word property means land, so land accounts are always going to be first. Plant is about buildings, factories, things like that, so that's always going to be listed second. And equipment is the last one, is always going to be listed third. So actually, when it says property, plant, and equipment, they really mean it. That's not the case for intangible assets. They don't necessarily have a particular order. But here the Coca-Cola company has trademarks and goodwill and franchise agreements with their bottlers that obviously have a value. All right, so one of the more important things here is return on assets. And return on assets is basically, are your assets generating profit? So return on assets simply is looking at your net income, which is your profit, divided by your average total assets. That's basically what it is. Your assets should be generating profit. So here you've got JetBlue, 2014 numbers. This is their profit. This is their average assets. You add those two together and divide by 2. And it's 6.8%, which is very, very good, which means that for every dollar of total assets, they're generating almost a 7-cent profit on every dollar of total assets. That's very, very high. As you see, the industry itself only has a 4% return on assets. So for every dollar in assets, they're only generating about 4 cents profit. So obviously JetBlue is doing quite well. Southwest is also doing quite well. 5.6, almost 6 cents profit on every dollar of total assets is really a good margin as well. Okay, so that's really easy. And the last one is something called an asset turnover, which simply looks, are you using your assets to generate sales? I mean, the reason you have all these assets, property, plant, equipment specifically, is to sell your goods and services. So how is that going? That's what this basically is telling us. So you look at your net sales compared to your average total assets. So here for JetBlue in 2014, they had $5.8 billion in net sales, divided by average total assets, looks like about 7.5 billion. So that's 0.77 times. So another way to look at this too is for every dollar in total assets, they're generating about 77 cents in sales. You can look at it that way. Okay. Better than 2013, but not as good as Southwest. Look at Southwest. They're really using their assets quite well because their asset turnover at 0.94 times indicates that their assets are generating more sales for the company than JetBlue. And the industry seems to be doing better. That's all the airlines combined on average. For all of their total assets, they're generating about 80 cents in sales for every dollar of total assets. Again, JetBlue is a little bit behind the curve here, but not very far behind. Southwest is really flying. There you go. That's chapter 9 in a nutshell. Any questions?